Hey everybody, it's Pete. Welcome to Stocks for Breakfast. It is Wednesday, May 13th, 2020. I think today is going to be one of the most important videos I've done. I spend a lot of time thinking about how can I be the most impactful to you, to somebody I've never met before, while at the same time, obviously not giving specific advice to somebody I've never met before. For those of you that don't know, I own two trading firms in New York City. I've been trading full-time for 20 years. And if there's anything that I'm really, really good at is getting people through the stages of the journey of the trader's path so that you can actually get to the point in the market where you have 100% conviction in what you're looking at. And then only then can you pull money out of the market on a weekly and monthly basis with consistency. And let's face it, that's really what we're all after, right? We all know that there's going to be trading days and weeks and months where the market might be a little tough, but that's different. Market conditions being tough is different from you going into the market every day saying, I expect to make money because I know exactly what I'm doing. It's a question of follow through. And if we continue to work together through these videos, if we continue to have a dialogue, whether it's here where you leave comments or you take the next step and you jump into our coaching program, into our 30-day boot camp, the interaction is really what it's all about, because without having a back and forth, it's very challenging because you have all the ideas in your head and you're not even sure if they're right. Which actually leads me to the topic of today's video. Today is my top five rules, guidelines, whatever you want to call them. I'm going to go from 5 to 1 in the order that I think are the most important things to accomplish or consider while you are trying to pull money out of the stock market on a regular basis. So we're going to get right into it. If you can please do me a favor, click down. If you find these videos helpful, absolutely click down and subscribe. Give us a thumbs up. And please feel free to leave a comment, feedback, or something that is challenging you right now. And we'll be more than happy to get to it as soon as we can in a future video. So we're going to start out with number 5. We're going to go backwards. And this is kind of a controversial one, but I just can't stress enough how strongly I feel about this. Don't use a simulator. Maybe use it to learn a software, but don't use a simulator. Anybody who tells you to get on a simulator is doing you a disservice. And I'm going to tell you why. Over the years, obviously, when I owned my prop firms, you would have new people coming into the business, new people coming into the firm. And the first thing you do is you put them on the software. And while they're on the software, they're learning your strategy, they're learning what you do, or maybe they're trying to feel it out on their own. If it happens to be a prop trader, maybe come in with their own ideas on how to trade. And they gain this self-confidence because of money that they made on a simulator. Simulators are garbage for your real-world trading results. You will get fills automatically, regardless of whether or not the liquidity in the market was real. You have zero emotions to a simulator because you're going to hold trades a lot longer against you and in your favor because it's not real money. There's no emotional attachment to it. There's no real world attachment to it. So I'm not going to beleaguer this point or beat it into the ground, but I'm going to tell you with 100% conviction, a simulator results will never, ever translate into the real world. I'm telling you it won't. And the only way to get that across is to think about trading, think about playing Xbox or PlayStation or any one of those things, and being a motocross or driving a car or any one of those things, and then actually believing that you're going to take those same skills out on the road. It doesn't work. I'm telling you, it doesn't work. So number 5 is don't believe any results you have on a simulator. Use a simulator to learn a software, to set up your charts, to learn your keys, learn your execution system and that kind of stuff, but don't use it to feel confident. Number 2, which actually brings me to the next one, is trade small. So actually number 4, we're going backwards. Actually number 4. Number 4 is trade small for at least 3 consecutive months until you're profitable. That's right. Don't trade big, regardless of how much money you have, until you are profitable. There is no reason to expand your risk profile until you've actually proven you could generate money. At the very, very least, you have to first learn, you have to see your losses start to decline. You have to get to a point where you're like, okay, every day maybe I'm not coming out the other side and making big money yet, but I've clearly started to lose less, which means two things. You started to be much more disciplined in executing your stop loss. And hopefully you've gotten to the point where you're making a list of what not to do, and you're staying away from some of those ideas. So for example, picking a top or picking a bottom, or getting involved when it's kind of in the middle of nowhere. So I'm actually going to go very quickly over to the chart, and we're going to come back in a second. So you need to be able to navigate something like this, back to something like this, and then this is the hardest part right here, when we're in the middle of nowhere. That's where a lot of money goes to die, in the middle of nowhere. So you need to experience those three different kinds of market conditions: a dramatic decline, a dramatic rally, and then going sideways. So that's why you need at least 3 months. I'm saying 3 months. It actually should be based on how profitable you are and how your equity curve is going in your account. I'm using 3 months as an example because you need to see different market conditions, which that kind of actually is 3 months. That was just coincidence. To understand how to trade both. So while you're doing that, to be good, to really expand your the depth of your trading knowledge, which will expand your trading account, hopefully, you start to write down in a trading journal how you traded each different condition: a bull market, a bear market, a sideways market. And then in the future, you'll actually have something to go back to that is your own real world experience, which, by the way, that is the most important book you will ever read, provided you write one, a trading journal by far. So again, 3 months of trading small, regardless of how much money you have in the market, to prove that you can understand how to make money. And the only way you can do that is to actually make money. So do yourself a favor, regardless of how wealthy you are and how much money you have in your account. Trade small until you prove you can make money. The next one, the risk per trade. So now getting back on it, now we're talking about an individual trade. We just talked about what to do over 3 months. Now we're talking about trade by trade. The risk per trade should always be a dollar amount you accept prior to putting the trade on. Now here's why that is. It's a pretty deep statement, because what ends up happening is a lot of people like to risk or trade, not so much a risk per trade. They trade like, I want to word this properly. They put on a trade, and when the trade gets down to their stop loss, very often they move the stop loss. They said, no, not yet. I know the stock, it's getting down to that area. So having a dollar risk per stop, per trade that you accept, means that prior to putting on the trade, you have absolutely said, if it gets down to that level, I'm getting out and I'm okay with losing $300. If you do not do that, if you don't say, I'm willing to risk $300 on the trade, and it gets down to that spot, you're going to take much bigger losses. And when the volatility in the market changes, you're not going to understand how to adjust your share size. So what I mean by this is, when the pandemic started and stock prices exploded, when volatility exploded, the size or the average true range in stocks went from here to here. They expanded dramatically. So that means that your stocks fluctuated dramatically. Here's the key. So when I say the same dollar amount per trade, your stop loss is obviously going to expand as the VIX expands. So what you want to be able to do is trade that same $300, but trade it differently based on share size, because now your share size has to decrease because your stop loss increased to trade that same 300. So goal number 3, or rule number 3, guideline number 3, whatever you want to call it, go into every trade saying, I'm willing to risk X amount. I'm just using 300 as an example, and say, okay, $300 divided by a $1 stop loss, that means 300 shares. So you understand how to calculate that now? So if it's $300 by a 50-cent stop loss, you can double that, because now you have a smaller stop loss for the same dollar amount. It's a very simple calculation. Just pick a dollar amount, and then the share size or the contract size is commensurate with how far that stop loss is. So now the VIX is coming all the way back down. And I'll just give you a very quick example of what I mean by that so you can understand what the VIX means. So if we take a look at the VIX, which is volatility, it was all the way up here during the pandemic, and now it's having a slow grinding move down. So during this spike, prices and average daily ranges were exploding, where the SPY was having $10 days without a problem, and now you can see it's coming all the way back down to what many might consider normal levels. This is what it looked like prior to what's going on in the world. So again, a dollar amount per trade. That's the biggest thing. Risking the same dollar amount that you're comfortable per trade, and as your account expands, hopefully that dollar amount will expand with it. And that's actually one of the keys to the kingdom too. If you've ever read the book called Fortune's Formula, they really get into that in a big way. Next, number 2, finding your edge is the number 1 priority, which actually, by the way, takes us back to number 5, which is simulated trading. You want to be testing your edge in a real market to determine if it works, and number 2, how it works in different market conditions. So finding your edge, finding your probability is actually the second most important thing. Actually, there's something more important than that. Second most important thing that you could take into the market to learn how to grow your equity and have that conviction. Remember, our number 1 goal is to wake up every day when the market's open and say, I absolutely expect to make money. And the only way to do that is to know exactly what you're looking at. Because in people in the coaching program, one of the biggest, most amazing things to me that I hear is I don't see anything. And I know that sounds kind of strange that actually excites me, because it sounds weird. It's like, why would I get excited about somebody saying I don't see anything? Because of the opposite of that. If they don't see anything, that means that they're telling me that they know exactly what they're looking for. So if they know exactly what they're looking for, that means that they have a very structured way that I've showed them, which in my case is order flow, that they know that if this happens, they will be doing this. If this happens, there's a higher probability of it following through, which again, if you've watched the video on 10 perfect trades, you can actually watch the video here on the channel. It's not about being right or wrong on every trade. Matter of fact, it's none of those things. It's allowing your trade to play out every single 10 trades, which you flawlessly have to execute on each and every trade, which actually we're gonna get to that next. So number 1, flawlessly trade your edge, which also means avoid everything else. The number 1 thing, and you could even have the most basic strategy, and I'll just give you this for an example. Let's say your entire strategy is, if today's positive from yesterday, if this Monday is positive from last Monday, just keeping it doesn't have to get into everything else. But if that's your strategy, your number 1 job is to do exactly what you said, which in that case, let's say I'm always going to be buying. Doesn't matter what else is going on, I'm always going to be buying. The second part of that, which by far will astronomically make you a better trader like that overnight, means you have to avoid, reduce, and eliminate everything that has nothing to do with what your strategy is. Because by the very definition of having a strategy means that I believe this is going to happen more often than not. And if I follow this flawlessly, there'll be some wins, there'll be some losses, but over time, you should make money if your edge actually has a positive expectancy. That is including those losses within your edge. But now think about if you take trades that are not your edge, so you're not flawlessly trading your edge, you're now pushing out further and further and further how many trades it will take you to get profitable, which is actually the secret, the little known secret to why most traders who are smart don't make money, because they are taking all these trades that don't match their strategy. So maybe it would have taken them 10 trades to get profitable, but now they took 4 trades that aren't at all in their strategy. So now it's 14 trades, and then they do that again, and now it's 18 trades. So it's like being in the water pushing a balloon away that you just can't catch. You are the reason that you can't get profitable if you work super hard and you're smart, because you're the one who keeps taking these trades that are blowing up your own strategy, which is why algorithms that make money are profitable, because they don't break the rules. So it's your job to first have the rules, and then your job number 2 is to flawlessly execute the rules, so that you allow your edge to do the hard work, which is something that most traders don't understand. It's not you actually doing the hard work. Your edge does the hard work. It's your job first to find the edge and then ultimately trade it flawlessly. So those are my top 5 rules. Go back through them pretty quickly. Write them down. And if you have any questions, feedback, or questions about your own rules, absolutely leave a comment. We'll get to you soon. Click subscribe, give us a thumbs up, and be safe.